A home equity conversion mortgage, or what we call a HECM, is a federal housing authority insured reverse mortgage issued by the Department of Housing and Urban Development through approved lenders nationwide. It is intended for borrowers who are age 62 years or older. It has some unique features that make him a valuable tool in retirement planning and aging in place. This video will discuss if a HECM is the right product for you. At the outset, be aware, as I said earlier, you need to be 62 years or older, have sufficient equity in your primary residence, and meet the minimum residual income requirements of the FHA program. Let's quickly review the basic requirements for a HECM. Everyone on title, and therefore everybody on the mortgage, must be 62 years or older. You have to use your principal residence. You have to have sufficient equity in that residence. And you have to meet the minimum monthly income requirement. Let's assume you meet the minimum age requirement. Let's take a look at home equity first then. Home equity is the difference between your home's current value and the debt or liens on the home. In our example, our home is valued at $500,000 and has an existing mortgage of $150,000. And that means the home equity is $350,000. Let's further assume that our borrower can obtain a $250,000 HECM based on the $500,000 home valuation. In this example, that $250,000 HECM is sufficient to pay off the $150,000 mortgage, so the borrower does have sufficient equity to permit the use of a HECM. However, had the existing mortgage been $300,000 and the equity only $200,000, this HECM would not have been large enough to pay off the existing debt, and this borrower would not have been able to get a HECM. In general, if you're buying a home or refinancing a home, you will need between 50% equity at age 62, decreasing to a minimum 25% as you get older. In general, the older you are, the less equity you will need to qualify for a HECM. The next requirement that you must meet is the minimum residual monthly income required. One of the great advantages of a HECM is that the income requirements are far less than a traditional forward loan. What is minimum residual income? Well, residual income is what cash you have left over from your monthly income after you've met all of your financial obligations, including property taxes and insurance and any other property charges, any payments on installment or revolving credits, the payment of income taxes, and similar type obligations. The residual income is based on the U.S. Department of Veteran Affairs residual income tables, which vary depending on the region of the country you live in and how many dependents are in your family. The more dependents you have, the larger the minimum income required. What is a dependent? Well, it's someone who lives in the house with you. You can see the Northeast residual income displayed on the slide. If the second person is your spouse and they're on title, his or her income can be also added to the total family income. If you have additional dependents in the house, if any of those dependents have their own income in excess of the minimum residual income required for an individual, for the purpose of getting the HECM, you can exclude them from the calculation. Always remember, with a HECM, the unused portion of the line of credit can itself help you meet the residual income requirement. We can spread it over the remaining life of the youngest borrower and call it income. Every loan has some risks, and the HECM is no different. Even if you have sufficient equity and you meet the minimum residual income requirements, you still need to know you can truly afford to stay in your property and can pay the property charges after you obtain a HECM, and of course meet your normal living expenses. And you should accept that it is entirely possible, depending on your usage or the prevailing interest rates or the property appreciation rates, and indeed how long you may live in the house, that you may have very little or no equity to pass on to your heirs. You need to be comfortable with this possibility. If you have any doubt whatsoever on these factors, then you probably should pursue some type of alternative. I think it's important we discuss what happens if you don't pay your annual property charges. Property charges include property taxes, hazard and flood insurance, homeowner association dues, land leases, and the like. What if your hazard insurance is not paid? The lender can buy forced place insurance and charge you for this insurance. It's very basic coverage and very, very expensive. If you don't pay the other property charges, such as property taxes, the lender is required to advance funds on your behalf to pay them as well as the forced place insurance above. If you have an unused line of credit on the HECM, the lender can charge that line of credit with these expenses. However, if you have no capacity on the line of credit, the lender will create an advance account and add it to your loan. You will need to repay this advance account over periods ranging from 12 to 36 months depending on the dollar size advanced. Larger amounts get longer periods of time to be repaid. You will also need to stay current on new property charges while you repay the advance. If after this lender assistance and any other help the lender can get you from, say, local authorities, you either fail to repay the advance or you default again on the property charges, you can likely face foreclosure and the possible loss of your home. So it is important that you can afford to stay in your home. Even if you can afford to stay in your home, and you have sufficient equity and you are over 62, there are times when you possibly should not consider a HECM. We say possibly because everyone's circumstances and goals are different, and what makes sense for you may not apply to another family. At 62, you can still live a long time. Time and risk are connected. The longer you live, the risk something unforeseen can happen go up. You can run out of resources. If you plan to work and make a living for a while yet, getting a HECM may not make sense unless you just plan to build financial capacity for the future. If you are prepared to sell and downsize or move to a smaller place, then this is likely the best plan over taking on extra debt. Aging in your current home may not matter very much to you. You certainly don't want to take a HECM if you cannot live on your residual income, unless the HECM itself can provide that residual income. If you are paying a high upfront mortgage insurance premium, you probably shouldn't take a HECM if you plan to move within the next 2 to 3 years. It's a very expensive form of borrowing if you're only going to stay in the house a short time. If you plan to invest the money in some higher risk or high fee transaction, using your home is not a smart thing to do. A HECM costs more money than a regular mortgage, and using those proceeds in a high risk venture is not advisable. You're putting your home at risk. And if you don't need the money now or in the future and don't want to build up a financial reserve for the future, you may not want to take a HECM at all. However, if you think you may need it in the future, delaying the HECM may mean you qualify for less proceeds if interest rates rise, or possibly your residual income falls, or maybe your property goes down in value. You have to balance these risks as well. If you want to learn more about reverse mortgages, go to Amazon.com and find the ebook Reverse Mortgages for Retirement. It's got about 130 questions and answers on the most important aspects of reverse mortgages. Or if you like, reach out to me and I'll send you a copy. I also recommend you go to our website, jmcapitalreverse.com. It's loaded with information for both professionals and for consumers. Finally, if you think I can help you, reach out to me at my email or call me on my cell phone. I'd be delighted to answer any questions you have. I hope you have found this video helpful.